property investor and a property developer for about 15 years now. Prior to that, I was a forensic scientist working for the government for, again, about 15 years. And when myself and my husband got into property, we both, after about 5 years or so, left our previous jobs, went full-time in property. Just by pure fluke and luck, managed to ride the boom through the 2000s, built up a big portfolio of properties in the Midlands. The credit crunch hit, we sat back for a little while, just decided what to do really. Then the builder friend of mine just said to me, "Oh, I think you'd make a good mortgage advisor." And I thought, "Oh, that sounds interesting." So off I went, did CMAP, and just started my own brokerage basically about 2009. Didn't do a lot for first couple of years while I was getting things going. And then somebody on one of the property forums said, "Oh, I didn't know you were a mortgage advisor." And I thought, perhaps I better start telling people. And that was it then. It was just like opening the floodgates. The last 3-4 years has gone absolutely crazy. Because of my social media profile, it's enabled me to get a really good reputation with the lenders. So I've got a direct relationship with them, pretty much all of the commercial lenders, direct to those. And also become a bit of a specialist in sort of HMO and commercial type finance. And even though I don't do HMOs myself, we only do single lets, which is a good thing because I haven't got any rose-coloured glasses where they're concerned. It does mean that I've got a really good understanding of HMOs and the funding and the lending aspects, and that also enables me to work really closely with the investors and the lenders as well. I've also helped a number of the commercial lenders actually develop their HMO valuation policy. So yes, I do a lot of HMO and commercial funding as well, which I really, really enjoy. Stuart, my husband, mostly looks after the portfolio now, and I concentrate on the finance side, which I absolutely love. I feel like I've ended up doing what I was always meant to do. I really love it. I love the whole problem solving side of it, and I get a lot of complex and unusual cases, which I really love as well. Experience is the key for most of the lenders. Don't get me wrong, there's the odd product, probably, 1 or 2 lenders maybe that would lend to first time landlords, possibly maybe one lender for a first time landlord, not that I would actually advise it. But pretty much all of them want some experience, and that can vary. You'll see people on the forums and Facebook and things saying, "Oh yeah, well I got this because of this," but often there's other factors in the background. So if you've got a really good background income, or I've done first time HMO mortgages for a client that actually is a letting agent, so clearly they've got a lot more experience even though they were a first time landlord themselves. That's a big difference to somebody who's just packed in their job to become a full-time landlord, has no properties in the background at all, and wants to pile straight into doing a 10-room HMO. So there's an awful lot of variables out there, and it's not as easy to just say, "Oh yeah, well I did it," or so-and-so did it. But essentially the vast majority of the lenders that are lending on HMOs are going to be looking for experience. And that can be anything from one of the lenders requires you to have 3 years experience as a landlord. Another one wants you to have a minimum of 5 buy-to-lets or 2 HMOs. Another one wants you to have experience in the sector that you're lending in, so HMOs for a minimum of 2 years and be able to prove it. Other ones will insist on you being a homeowner, an owner-occupier. Others don't mind if you don't own your own home as long as you own other properties. So there's a lot of different factors there, but I think the main one, and something I would certainly advise as an investor myself and a landlord myself, is to actually get a bit of experience first, and don't just dive into doing HMOs as your first opportunity. Neil, so is that the end of the interview? Yeah, it's all over now. No, realistically, it is next to nil, and it's not even a case of being pessimistic or anything like that. The lenders want to see that you've got something invested in that deal. They're the ones putting up most of the money. Why shouldn't they see that you've got something invested in it as well? Just owning the property and wanting to see the rent come in is not enough as far as they're concerned. They actually want to see that you've got some meat on the bones, something invested in the deal. If you can go into refinancing a property or doing a bridge to term arrangement or a HMO refurb, and set the deal up so that you're looking to leave in about 10% of your total costs. One, that's going to be a better thing for you to actually get lending that's going to make a lot of sense. The second thing is that you're actually going into that deal showing the lender that you're not trying to do a no money down, no money left in deal. And you're going to get them on side straight away when you can understand it. And when we present our deals for clients to the lender, that's exactly how we set them up. And we actually try and demonstrate that the client's leaving in some money. And when you do that, you get them on board straight away. If you go in, lenders aren't daft and valuers aren't daft. If they can see that you're trying to structure this deal to get all of your money back out, it's instantly going to get their back up, if you know what I mean. They're going to be straight away thinking, oh, we've got one of them. And you're far better going in demonstrating that you understand the deal, you understand lending, you understand how the lenders work, and that you're happy to leave money in. Because if you get the back up day one, actually it'll probably backfire and you'll end up leaving in 20%, because you'll just get a down valuation, you'll get an underwriter who thinks, well, if we've got one of those, then we'll just do lower lending or we'll reduce the loan to value. I've seen properties that have valued at, I can remember one quite clearly, really stunning HMO, 15 rooms, really gorgeous, probably better, well, it was better than most people's homes. And the valuer and the underwriter actually spoke about the deal before finalising the valuation report. And the valuation report itself said there is, without a doubt, the property is worth £1 million bricks and mortar value. Without doubt, the property is worth somewhere between 950 and £1 million on a yield value. However, for lending purposes, the property is valued at 680,000. And the reason behind that was that the underwriter and the valuer and myself, because I'd put the deal together, actually knew exactly what all of the investors' costs were. He bought the building for 250,000, he spent 250,000 on it, and then he'd got some extra costs as well. So they valued it deliberately for lending purposes so that he would be leaving some money in. And that is not unusual. I've seen lenders come back and say, well, if we lent at 75%, even though the product is 75%, then they'll get all their money out. So we're happy to lend at 70%. I've had one very recently where they were happy to go, actually did a bit of a compromise with the lender in the end, which is the great thing with commercial lenders. You can have a conversation with them and often compromise. But we had one recently where they would rather have lent at about 65 to 70%, so the investor wouldn't leave all their money in. Wouldn't leave any money in, and what we actually negotiated with them in the end was a 5% repayment. So they got pretty much all of their money out, but we put 5% of the loan on a repayment basis. And just little things like that can make the lender just realise that you're prepared to pay some back, to leave a bit of money in the deal, to take a bit less cash flow, and that you're not looking to asset strip effectively. That's what really worries lenders. So if you go in with that approach day one, you're going to get them on side instead of doing the whole I need my money back out straight away. And if you've got a strategy that relies on you getting all of your money out on every deal day one, it's probably the wrong strategy anyway. If you've got some growth as well and you've sat back and you've left your money invested for 12 months or so, it shows the lender that you're a lot more mature, a lot more have a much better approach to how you're doing your investments, a lot more mature in your investing, and that you're happy to leave some money in and then come back after the dust has settled a little bit and gone back after sort of 12 or 18 months, and then perhaps look to take some money out that way. I think the only caveat that I would say with that is that some of the commercial lenders simply don't have further advance policies at all, or just don't allow further advances. So you need to get your lender right as well, that if you're happy with that strategy, you're going to go with a lender that actually does have a further advance policy and lets you pull out some money later. And some of the commercial lenders don't actually do that. So again, it's about just knowing exactly what you want to do through the property journey and perhaps for the next couple of years, so that you know at what stage you want to pull some money out and use the right lender to do that. It's no good being with a lender on a 5-year fix and they just simply don't allow further advances if your whole strategy revolves around getting your money out in 12 months' time. There's HMO refurb products where you can, the whole aim of them is that you buy the property as is, do the conversion, do the work, and then pull some money out that way. Bridge to term products work in a similar way, except they're bridge and then you move over onto the term product afterwards. So it's just beginning with the end in mind, really, and going in with which lender and which product suits what you want to achieve. And you've got to have those, you know, big in-depth discussions with your mortgage advisor. And I do that. People phone me up and it's like, I need a mortgage yesterday and I'm buying this HMO and I want it done. It's just not going to work that fast, particularly with HMO. So you may as well have the conversation about what the longer term plans are. With commercial lenders, you need to be thinking about 3 months typically, if not longer with some of them. Some of the more traditional banks, let's say like Lloyds and lenders like that, are taking up to 6 months with new borrowers. So going in and, as I say, buying a HMO at auction or with a deadline or anything like that and expecting to get commercial finance and HMO finance is just not going to happen. You need to be thinking about true bridging, not even the bridge to term or the refurb products. They will all still take a good 6 weeks on average, even with the commercial lenders. So if you do have a deadline, you want to be looking at using true bridging, which is obviously going to add to your costs, so you need to factor that in as well. But don't just pile in and get a HMO or think you can get a HMO on commercial finance and meet any sort of deadline, because you won't. The paperwork requirements and everything, which we'll come on to, are a lot more in depth. It's effectively all manual underwriting. You will typically have a case officer that looks after your case. Everything's very manual. It's not like buy-to-let or even residential where it's all computer says yes or no. They'll still do credit checks, but that's about as much as they do computerised. Everything else is a manual process, and that all takes time. So don't go into anything. And certainly the absolute worst thing you can do is go in and get a buy-to-let mortgage on something because you want to complete on it quickly and then think about what you're going to do with it and convert it to a HMO and things. That's a definite no. So again, speak to your mortgage advisor what your plans are, and if there is a deadline, get that sorted up front, because it may be that you need to go bridging and that the costs of doing the bridging just don't make sense with this particular deal. If somebody is putting in money for a purchase and there is other lending involved, then the lender is going to expect that person to actually be on the mortgage with you, or the bridging loan or the term loan. None of the lenders are going to accept a gift from a stranger, and they're certainly not going to accept money being given on any sort of joint venture or deed of trust basis or any sort of loan agreement that's contributing towards a deposit. Lenders just simply won't accept that. So the other party needs to be actually on the loan. And then you have other issues that you need to consider, which is you connecting your finances together. So if you took out a 15-year term loan, you're connecting your finances together for actually probably about 22 years, because your associations will be on your credit files for 7 years beyond the end of any last association. So what's really important to consider with this is that if you don't know that person implicitly, trust that person implicitly, and they miss a credit card payment or miss a mortgage payment and it happens, or worse, get into an IVA or debt management plan or a bankruptcy, that will knock onto you. That will affect your searches. So when I get new joint venture partners come together, and some of the lenders just simply won't lend on this basis at all. If they know that you don't have a pre-existing relationship, they just will simply decline. But of the ones that will, when I do get new joint venture partners come together, I say to them, here's a really good test. Every 3 months, produce all of your bank statements to each other and your credit files. And quite often they will just be horrified at the thought of doing that. And I say, why on earth are you going to go into a financial relationship with this person then, if you're not prepared to share your intimate details about your finances with each other? And scary things about people going, meeting at events and things like that and just handing over 100 grand onto deals and going onto mortgages together and things like that without realising the actual implications. Yeah, a couple of things, I think. One, I mentioned paperwork and documentation. Don't get me wrong, as I say, these lenders tend to be slower. They are manual, But the biggest delays, without a doubt, every single time, I'm sorry, do come from the clients and providing paperwork. So get your ducks in a row with all of your paperwork as soon as possible. Some of the things that these lenders are going to be looking for, SA 302s, they can take 2 to 3 weeks to arrive from the Inland Revenue. So you should be getting those every single year. It's a good opportunity to mention that we're coming up to October. That's deadline time. Lenders are going to stop accepting 2014 SA 302s as the last tax returns. They're going to insist on 2015 from about October. So even though your tax returns aren't due until January next year, it doesn't matter as far as the lender's concerned. They will want to see 2015 SA 302. So if you've not done your tax returns yet, get them in as soon as possible, because if they ask for them and you don't have them, they'll simply decline. So we've got SA 302s, your physical tax returns, the electronic ones that typically you or your accountant will do, they'll often ask for those. It's anywhere from 6 to 12 months bank statements. That will be personal bank statements, all of your rents and your mortgages. It really helps the lender and the broker if you can itemise on the statements which properties the mortgages and the rents relate to. Otherwise they'll come back and just ask for those if it doesn't make any sense to them or they can't match them up on your credit file. Anything like HMO licences, planning, building regs, your personal ID documents, portfolio schedules, proofs of address, also a schedule of works if there's been any works done to the property conversions, and keeping large invoices as well. They won't ask for every single invoice, but if you've had a builder come in who's done most of the work, they'll sometimes ask for the larger invoices just to get a feel for what works have been done on the property. The big tip that I would give is what I mentioned earlier, which is always begin with the end in mind. If you need a HMO refurb product or a bridge, then you've got to factor in the costs accordingly. Don't just think you can pile into getting a HMO mortgage on a property that isn't currently a HMO. That's just not going to happen. So you have to get the right mortgage, the right lending. And I see so many people on the forums and who contact me who've wasted money on valuation fees, legal fees, broker fees, trying to line up a HMO loan on a property that isn't yet a HMO. That's just not going to happen. You're going to need the right finance, a refurb mortgage or a bridging loan or a bridge to term type loan to acquire the property, do the work, and then move it over to the proper loan. So that's the next tip that I would advise is just being upfront about what your plans are, particularly with your mortgage advisor. They can't see the property. They don't know what your plans are. So if you don't tell them, they're going to, if you say, oh yeah, it's a 6-room HMO and you've paid out £750 for a valuation fee and some legal fees, and the valuer comes back and says, no, it's a 3-bed terrace and it's not set up as HMO yet, they're just simply not going to lend. You've wasted everybody's time and money and you probably lose the deal. So you do need to be upfront about what your plans are, and then you can get on the right finance from day one. The other big tip that I'd given that's quite relevant at the moment is with the tax changes, which I'm sure pretty everybody knows about. If anybody's reading listening and not signed the petition yet, then please do go sign the petition. But where we are at the moment is that these tax changes are imminent. They're going to start coming in 2 years' time and then be fully in by, I think it's 2020, and they are going to have a massive impact on all landlords. Where there is potentially a bit of a loophole is putting properties in a limited company. Most of the lenders for HMOs will also lend to limited companies. So again, beginning with the end in mind, it is well worth anybody doing HMOs from this point forward considering putting the properties in a limited company. But again, you're going to need your company set up in advance. It's no good going off to auction, agreeing a sale and then having to set up a company and everything else that might take 4 weeks to actually do and get that right. But you do have knock-on effects with using a limited company. Some of the lenders won't lend if there's other lenders involved in the limited company. So if you've got Paragon, for example, lending on a limited company, they won't allow any other lenders to come in. So you might have to set up multiple limited companies for multiple properties, depending on which lenders you're going to use. Some of them will allow cross-collateralisation. But again, it's really important that you know which lenders will do that from day one. Otherwise, you could find you put a property in a limited company and then you can't get lending on it because the only lender you could go to is Paragon, and you've already got lending with Shawbrook in there. So you're going to end up having to sell the properties out of the company, and that creates all sorts of problems. So limited companies, I think, is definitely the way to go for HMOs going forward. But you need to be really careful about which lenders you're using on the limited companies and the properties. Thank you very much, Wendy. I really appreciate it. Thank you.